Thank you very much, Rosé. Good afternoon, everyone. My name is Xavier. I'm from S&P's Global Corporate Ratings team based in Singapore. And what I wanted to do today is share with you a few perspectives on what we learned from the COVID crisis and tell you a little bit about how we think the path to recovery is going to look like. So this is the agenda for today's session. I'll start with giving you a little bit of context on the Asia-Pacific corporate credit trends, some of the near-term perspectives that we are observing. Then we'll jump into geographies, sectors, and how those have performed amid the COVID situation. And then we'll speak about credit lessons that we learned after COVID, because a lot of the commentaries and articles that we have put out there are about credit impact and the path to recovery and so on. But I think it's very interesting to step back a little bit and spend some time on what credit lessons we have discovered, or that have kind of come back to the surface after the COVID situation. And then no session on credit in Asia Pacific would be complete, I think, without having a discussion on state-owned companies. So we'll be speaking for a little while on the state-owned sector in Asia Pacific. And of course, we'll be very happy to see and answer some of the questions you may have at the end of the presentation. So let me first start with the big picture for credit in Asia Pacific. So what this chart is showing you here is how S&P looked at credit over the past 18 months in Asia Pacific. So we rate between 700 and 800 non-financial issuers, so companies, infrastructure, state-owned firms, and so on. And what you can observe on the chart, of course, is numerous credit rating actions that have taken place between February and September, predominantly rating downgrades and a number of rating changes to the negative. And what we can also observe from that chart is, since the beginning of the year, the credit behavior seems to have stabilized. You see a little bit more proportion of green on this chart. So either companies where we upgrade the rating, so credit quality improving, or companies where the rating has stabilized, maybe it was on a negative and it became stable. So a gradual improvement in the credit picture of the corporate sector after a very turbulent 18 months. Today, what is important to understand is we seem to be out of the wood. That picture is suggesting that the credit situation is out of the wood in Asia Pacific, but that's only half true. I mean, it's improved clearly since the beginning of the year, but we still have a fair number of companies with further potential downside risk to their credit quality. That proportion is between 15 and 20%. It's been fluctuating around that number for the past 3 months. It's a sharp decline from about 30% at the height of the crisis in Q3 2020, but it's still above the average of about 10% that we had observed before the COVID. So really, downside risk is reducing, but it's very slow, and there is probably more downside risk to come. The next thing I want to show you guys is where COVID has hit, and the fact that we could have expected much more pronounced widespread financial distress in Asia Pacific. I mean, when you think about it, we had months of people being stuck at home, locked down. We had a complete stop of the economy in quite a number of countries in Asia Pacific. Air transport coming to an halt, a lot of shops closing, and so on. And I think, in Q1 and Q2, when we were looking at the credit situation, we were a little concerned that we would see a lot more financial distress and default situations. And that hasn't really been the case. Since the beginning of 2020 in Asia Pacific, the default rates, of course, have increased, but not in an uncontrolled manner. And What that chart is showing you here is at which rating level S&P has taken the largest share of rating actions. And what you can see is companies rated in the BB category and above, of course, they have seen rating movement, but it's only affected between 10 and let's say 20% of the companies that we rate. Most of the rating movement, most of the downside situation has taken place at the weakly rated category. So companies that were already facing some structural weakness, maybe because they were small, or maybe because they had a lot of debt, or maybe because they had some liquidity issues. And we could see financial stress coming, I would say, for the large majority of the companies that faced financial difficulty. So about a third of the companies that we rate in the B category were downgraded, and nearly 2/3 in the CCC category were downgraded. But to be a CCC to start with, you have to have a severe weaknesses from a credit standpoint. So there hasn't been massive credit events. There hasn't been a wave of defaults. And that's an interesting insight from what happened in the past 18 months. What have been the key differentiator between the companies facing difficulties and the other ones? I would say there's four of them. The size, first of all, we haven't seen a lot less large companies facing financial difficulties than small ones. Business diversity, of course, when countries close their economies, or when transportation stops, or when retail shops are closing, if you just have your assets in one location or in one country or in one business, you will be a lot more affected than if you have a global footprint or a much bigger size. So size and diversity have been key considerations. But I have to say that access to funding has also proven a key differentiator. Companies with a lot of funding options have been able to tap them as they needed, compared with companies that only relied on one funding source, like the bond market or domestic banks or working capital loans. That said, today, when we look at the issuers that we rate in Asia Pacific, a lot of the overall credit quality has weakened. We haven't seen a lot of defaults yet, but the credit quality has definitely weakened. And we think that today we are probably not completely out of the woods yet. We still rate between 12 and 15% of the companies in Asia Pacific in the B rating category, about 5% in the B- rating category and below. And what this is telling us is we will see more defaults in Asia Pacific in the corporate sector. We had green shoots in the economy at the beginning of the year. Now you are having a second set of lockdowns in quite a few countries, from the Pacific to Southeast Asia. And in some of the most affected countries, and I'm thinking in particular in Indonesia, in some of the other Southeast Asian countries, the situation is probably worse than it was at the peak of the first wave in the first quarter. So we think default rates there are likely to grow, and we will see more credit events taking place in the corporate sector in Asia Pacific. If we look at the sectors that have been the most affected, I think there are some interesting trends there. So the first is, of course, those sectors that were mobility related have been the most hit from a credit standpoint. So what that chart is showing you here is the four sectors that have experienced the biggest number of rating downgrades. They are all linked directly or indirectly to mobility. And of course, mobility has stopped during COVID. So these were, of course, the ones that saw their credit quality affected the most. Automobile, hotels, gaming, restaurants, cyclical transportation, like airlines, and then commodity companies. So these have been widely affected, whether the entities within those sectors were large or whether they were small or whether they had a lot of debt or whether they had a little bit of debt. Everyone has been really affected. But I think another interesting trend is that even within a given sector, companies, the credit quality has started to bifurcate. So there has been more and more polarization, more and more company-specific aspects that are materializing. So for sectors such as real estate developers, which haven't been massively affected by the COVID situation in Asia Pacific, a lot of large companies have sailed through very well, and then quite a number of real estate developers have faced financial difficulties. So our credit analysis today is moving towards a lot more company-specific, idiosyncratic analysis, rather than just looking at the sector and saying, yes, it's affected, or it's going to be affected for a while, or it's going to be resilient. So we are seeing really the emergence of idiosyncratic risk, company-specific risk, where a lot more credit attention is being paid to in what we do. Speaking a little bit about the time frame for recovery. So this is a corporate heat map that we have devised, that we have first initiated in the first half of 2020. And what we did at the time is we tried to understand, okay, this is the situation for a number of sectors in the different regions that we cover globally. And this is what we observe from an operating and a credit standpoint across those sectors. And when do we think these sectors are going to be recovering to their pre-COVID level credit quality? So we started for the past year or so breaking those sectors into different timeframes for recovery. And this pictogram is showing the latest one that we have came up with. That was just in June for Asia Pacific. And what we observe here is that a number of sectors in Asia Pacific have already recovered, both operationally and from a balance sheet standpoint, to their pre-COVID situation. And these include retail, telecom, consumer staple. I mean, all those sectors that were a lot more resilient during the COVID crisis. A few sectors which we thought would recover a bit later have recovered sooner, and those are indicated in green in this chart. So technology, hardware, semiconductors recovering because of better than expected demand in the first half already of 2021. And what this chart is also showing is that the large majority of industries we think will only recover in 2022, and for the most part in the second half of 2022, especially those mobility related ones. And then you have a number of sectors, auto, transportation, airports, those that have been much more severely affected and maybe more structurally affected by the COVID crisis, which we think will recover only in 2023 or beyond 2023. So this is another way to say that the more resilient sectors have already recovered, but there is still quite a way off in credit Asia before we see what we saw in 2018 and 2019, which was more stable credit conditions in the region. Now, what I'd like to do is spend a little bit of time on some of the key learnings from a credit standpoint, because it's interesting to have the perspective. I think it's interesting to understand the sectors that have moved the most, the sectors that have suffered the most, or those that have been the most resilient. But there is a few credit items, credit factors that I think were a little bit disregarded in this period of the past 5 years, or even in the past decade, that maybe market participants haven't paid as much attention to as previously. And that's kind of logical, because when you think about it, between 2010 and 2019, Asia Pacific has been a fairly strong performer in the economic sense. Operating wise, growth has been very robust, revenues have climbed up, profits have increased, funding was widely available, and except for a few periods of credit stress, the Timeframe in 2013, the currency depreciation phase in 2015, 2016, commodity prices going up and down, we haven't really experienced a situation in which, economies have been closed for 3 months or 6 months. So to me, there has been some degree of complacency by market participants on very, I would say, very basic credit items like liquidity and funding, which were taken as given. So what we have observed in this crisis is that it's kind of coming back to the spotlight. Liquidity analysis is obviously the major cause of financial distress and defaults. The large majority of those companies that defaulted in Asia Pacific in 2020 were because of liquidity or refinancing issues. And a lot more emphasis, I think, by the market had been placed on credit ratios, long-term credit ratios, which don't really give a good sense of financial distress in the near term. They are very useful to explain the credit quality of a company in the long term, but not in the near term. Another thing I think is very important is refinancing seems to have been almost a given. The capacity of companies to repay or refinance their debt as it came due. The rollover by financial providers was almost considered as a given. So it didn't really matter that companies had a lot of short-term debt because they had a track record for the past decade of just rolling over those credit facilities or increasing their credit lines when they needed. But what we observed as part of COVID is the capital providers have become, I would say, quite scared at the beginning. And they looked at their portfolio and they said, well, these companies, I'm going to continue providing funds, but this company is facing either industry headwinds or has more operating challenges or financial difficulties or a weaker governance, and therefore I'm reducing my credit lines. So the rollover of short-term maturities, which was often assumed in the past decade, has really come back and been a lot more selective by the capital provider. So refinancing is easy in good times, but in hard times, there's a lot more selectivity. Another aspect, which I think was also disregarded a little bit and which is coming back to the credit spotlight, is the diversity of funding. And this is exactly a case of winner takes all. The large companies typically have much better access to different funding sources, whether it's the bond market, whether it's the bank loans, whether it's the ability to issue hybrids or sell assets. These funding options, give a lot of flexibility to large companies when one of the funding channel is more difficult to access. And that's very important, especially when refinancing requirements are growing. If a company only relies on the bond market or on working capital facilities to finance itself and that funding channel closes, then financial distress becomes very apparent. And I think it's no wonder that investment grade companies rated in the high BB or in the BBB category have been able to fund themselves so cheaply, because there's this flight to quality that is benefiting the very large companies. And then finally, I think credibility and the track record of liquidity management is something that's very important. In Asia Pacific, we have seen a lot of new issuers coming to the market in the past decade. They've come at the time where GDP growth was very solid, where the operating conditions were very favorable, maybe competitive pressures were less, profitability was solid, and they didn't really have to deal with a big liquidity stress or a big liquidity situation. And I think this crisis, this COVID crisis, is bringing us credit analysts back to the more fundamentals of management attitude, management track record in a lot of aspects, and attitude and track record regarding refinancing is really taking center stage now. When we look at liquidity and refinancing in our own credit work, I like to think about it in kind of summarizing it in two words, as I mentioned a bit earlier: options on the one hand and execution on the other hand. So options is really all the different things that a corporate issuer can do to bolster its liquidity or to help to help it finance its operations and its ongoing debt service. And options, they can include, of course, the foreign currency capital markets, the domestic capital markets, and these are growing everywhere in Asia Pacific. Attitude towards more traditional capital providers like domestic banks or foreign banks, the existence of core relationships, the ability of these companies to issue maybe more sophisticated financial instruments like hybrids, and of course the willingness and the capacity to sell assets or dramatically reduce capital spending in order to accumulate cash. But that's the options. Now, what is also important is what management teams do with those options. Will they be proactive? When they need to refinance, will they have clearly outlined funding plans, a backup plan in case what they wanted to tap is no longer available? What is the timeline for execution? So I think today we place a lot more emphasis when we look at credit on not only what's available for companies to do, but also on what companies themselves and their management teams are going to do. And here, track record and proactivity and having a lot more information about the timeline for executing this liquidity work and this funding is taking, I would say, a lot more precedence than the options that a company may have. Another aspect that I think was also a bit disregarded over the past decade or so, and that COVID has definitely brought back on the spotlight, is working capital. So for us, credit professional, financial professional, equity analysts, and everybody working in the investment sector, maybe those of you who have a CFA or a PRM or any other certification, we all learn about working capital, which is really the bloodline of companies. It's how companies manage their accounts receivables, their inventories, their payables, and you see when the operating conditions are very favorable, we seem to almost disregard working capital considerations because we see revenues going up and we see accounting profits going up. We see EBITDA going up and we see the credit ratios being maybe stable or slightly improving because the profits are increasing. But what we have observed over the past 18 months is companies, they need the cash. They need to convert revenues and they need to convert profit into real cash, because this is with the cash that you repay the debt and that you pay the interest on an ongoing basis. It's not with accounting profits. And the chart that you see here on the left of the slide is an actual existing Asian issuer. S&P didn't rate that company in particular, but it's listed. And I think it's very typical of what we have observed in Asia Pacific in a number of sectors for the past 5 years. So what that chart is showing here is it's showing you a line that has the rebased revenue. So here revenue started in 2016. Between 2016 and 2020, revenues have increased by about 2.5 times. So it's a great growth. It's 30–40% compounded per annum. Really, really incredible when you think about it. But then the other lines, what they show is they show the accounts receivables, the amount of inventories that the company has created, and the working capital requirement that is kind of an aggregation of the receivables, the inventories, and the payables. And what we can observe is revenues have increased a lot, but receivables have increased even faster, and inventories have increased even faster. And what that means is revenues are growing, but the way this entity is generating revenues is only by extending receivables to its customers. So it is recording the accounting revenues, but it's not receiving the cash very fast. And at the same time, because the revenues are growing very fast, they have to invest in working capital, they have to invest in raw materials, they have to build up their inventories. So what this is creating situations of a very clean and beautiful P&L or income statement with growing revenues, growing profits, and maybe even improving margins. But it's creating a bit of a nightmare in the cash flow statement, because those revenues and those profits are not translating into cash, and even translating into cash burn, because the companies are growing very fast. And there are some sectors in which this behavior is more frequent. These will be the working capital sectors like retail and distribution and property development and engineering and construction and commodity traders, where you effectively have to buy the raw material or extend a very lengthy receivable before you receive the cash. And this is a behavior that, from a credit standpoint, tends to be relatively negative, because you have to bridge that cash deficiency when you spend a lot of money and you don't receive the cash from your customers. And I think this is a behavior that you always observe when companies are growing very fast, when you have a business model which tends to be very niche, when you have a lot of competitive pressures which require you to do concessions with your own customer base. So you tell them, oh, you can pay me in 90 days or 180 days, it's okay. But that's actually creating some issues for you, because you have to finance the companies in the meantime. So a lot of the credit situations that we have observed in Asia Pacific, they have been driven because of working capital issues. So this is not intended to be a session too much on working capital, but we want to raise the awareness of market participants that this is a trend and a risk that is growing for the corporate sector in Asia. And as the economy improves, because at some point it will improve, maybe in 2022 or in 2023, companies will see a pickup in activity. And they will need to invest in working capital. And this could create another wave of financial distress, because working capital requirements today, they are very important, but they will become increasingly important as things improve. These are some of the things that we monitor at S&P from a working capital standpoint. Of course, receivables, payables, inventories, and the other current assets and current liabilities. I'm not going to go through each of them in too much detail, but I want to point you guys to a few things that we are seeing are increasing in importance, and maybe the one that I think is probably the most important when I look at credit for a company's management attitude towards working capital. Because management attitude, I think, is going to tell a lot on how the management team are seeing a potential runaway of working capital. Are they concerned about it, or do they think it's just normal, or are they relaxed about it? And what are they doing to improve the working capital conditions? And a lot of the issuers that have faced financial distress, the message from management team has been, we are a fast growing company, so working capital requirements are bound to grow anyway, so it should be no surprise. But when working capital keeps on extending and extending and extending, and management teams don't do anything about it, then I think it's a red flag or a warning signal that that requires us to pay a bit more attention to. Another aspect that I think is relevant, and that's going to be linked to the next topic that I want to speak about, is is groups and working capital that relates to related parties. When a company is part of a bigger group and is doing transactions, whether buying raw material or selling products to a sister company. And these kind of situations could actually create some governance or trigger some governance questions, and working capital changes to related parties we think are worth a particular attention when analyzing credit. On the topic of liquidity and financial stress, one of the learnings from the COVID crisis is that defaults or financial distress, they actually have taken place well ahead of big maturities. So what this chart is showing you here is it's showing you globally what the form of distress that companies have, that the companies have faced. So S&P records defaults when a company that we rate misses a payment, then we record it as a missed payment and as a default. So the ratings goes to D from wherever rating level it was before the default. But S&P also consider situations of debt restructuring, lengthening the debt or changing the terms and conditions of the original promise, potentially as a default as well, if there is no adequate compensation. So a Chapter 11 filing could be considered a default as well, is generally considered a default as well. A lengthening of a debt when a company has no other choice is also considered to be a default. So we classify those different types of defaults into different categories. And what this chart is showing you, which is interesting, is that only about a third of those defaulted cases are because they have missed a payment when it came due. And about 2/3, they have been, if I may say, anticipatory defaults or proactive defaults by the companies. Meaning that well ahead of maturity, 12 months, maybe sometimes even 18 months before a debt was due, a company has said to its creditors, I won't be able to pay. I know it's only due in a year or in 12 or in 18 months, but I'm not going to pay now. We need to sit down and we need to restructure the debt. And it is important, I think, to keep that in mind because backdated maturities may give a false sense of security on the financial health of a company. We may feel that because the debt is due in a year and a half or in 2 years, nothing is going to happen. The company is not going to default in between. And that's not the case. 2/3 of those defaults between 2020 and mid-2021, they have taken place well in advance of the stated maturity. So something to keep in mind for investors. We try our best at S&P to identify those potential cases where a company is going to restructure its debt well ahead of its maturity. And we have found that a few warning signals are useful to that intent. So when companies have too much debt, so unsustainable capital structure, they often do that. 10 times, 12 times debt to EBITDA, this would be an indication of unsustainable capital structure. When funding options start to narrow and a company really feels that it has no other choice but to restructure. Oftentimes bond prices drop very significantly and companies may be incentivized because they have no other choice to buy back those bonds at a substantial discount to par. And then the last case, of course, is much more difficult to estimate, but when companies have some corporate governance issues or limitations on their corporate governance or their reputations, there may be a willingness to pay issue, and in those cases, they may just decide to restructure. But the key message on this slide here is defaults and financial distress do not happen just a few weeks or a few days before a big coupon payment or principal is due. It can happen well ahead of that. Another aspect which I think is coming back to the spotlight is really management and governance. We are seeing really in our own interactions with the investment community a lot more questions on our thoughts of management and governance aspects. We are now in a situation where I feel investors are paying a lot more attention to the group structure, related party transactions I was speaking about a bit earlier, trying really to get more clarity on more complex groups. paying a lot more attention to the quality of communication, trying to understand really whether an issue at a sister company could snowball and could influence or contaminate, if I may use that word, the financial condition or the ability to refinance of a rated issuer. And what we see in Asia Pacific is there is a growing number of these complex groups, some of which may not be very transparent because a number of the subsidiaries may be unlisted or the communication may not be the best one. And when companies have a lot of debt, when they have a large near-term refinancing, investors, I feel, are paying a lot more attention to that and may decide to extend credit or refinance, or they may just hold back on that refinancing, and this is when the financial stress could materialize. As far as management and governance is concerned, I feel there is also a lot more emphasis, and I think it's a good thing, on the track record. Just something as simple as track record. And also track record of operating in good market and in tough market. Track record of financing in good conditions and in tough conditions. Planning consideration, articulating the financial policies. All of those aspects, they tend to be very qualitative. They cannot be seen so easily in just reading the financial statements. It's really going to be about getting a feel about the management of these companies, both operational and financial, and about the governance. And it's great that a lot of those are coming back to the spotlight. And I'm pretty sure that some of the credit situations that we will be seeing in the second half of 2021 and in 2022, a lot of them will be about management and governance and about liquidity as well. As I mentioned in my introduction, no session on a credit in Asia Pacific would be complete if we didn't speak about SOEs, about state-owned companies, or as they are also called, government-related entities. And I think here one of the key learnings from COVID, which I feel is particularly more acute for Asia Pacific and for SOEs is the leverage buildup. And what I mean is that leverage can build up, debt can grow very fast, and still be a little bit disregarded by capital providers and by market participants. And at some point, when there is too much debt, oftentimes companies have no other choice but defaulting. But in the meantime, debt keeps on growing, and these companies can keep on obtaining financing. So here I wanted to illustrate my point with the state-owned sector of a country that I've been looking at for the past decade, which is Indonesia. So what this chart is showing you is the growth in total assets between 2011 and December 31st, 2020. So a 9-10 year of asset growth in the state-owned sector for Indonesia. By the way, the state-owned sector in Indonesia is very typical of the state-owned sector in Asia Pacific as a whole, with fast-growing assets and fast-growing debt. So if you read this chart, you can see that for those companies where we have the financial information publicly available, listed ones and the rated ones, assets have grown anywhere between 3 times and 5 times, 6 times, 7 times. Even some companies have seen their asset grow 10 times, 15 times, 20 times in 1 decade. This is a massive growth in assets. And when assets grow so fast, either these companies keep on getting injections from their governments, or maybe they generate so much cash that they can finance this asset growth without having recourse to debt. But the fact of the matter is, debt growth has very closely mirrored the growth in assets. So this asset growth has been financed with a massive increase in leverage. It's lasted for a decade. And we are seeing only today the consequence of this asset growth because of COVID, of course, but not only. Also because companies just had too much debt and they had to restructure. And some of the key learning points here is, first of all, debt growth can go unnoticed and companies can survive for a very long time with very high levels of leverage. So that's, I think, a warning signal in itself. But for SOEs, there is an additional dimension, which is their ownership. And governments have in this region historically been very supportive of their government-related entities, meaning that when they needed cash, governments have provided support, they have provided soft loans, they have provided equity injections, they have supported those companies directly or indirectly. But now the fiscal position of governments is becoming a little bit more tight. And what we see across Asia Pacific, from Indonesia to China to Malaysia to Thailand, that governments are becoming a lot more selective in extending support to their SOEs. So first, because they may have a reduced ability to provide support, but also because they just may not want to bail out every single company just because they are a state-owned company. And when we look at companies now, we are placing, I would say, a lot more emphasis than before on both the ability of the government to provide support, but also on what form that support would take and how timely that support is going to become. This is once again taking the illustration of the Indonesian SOE space, some of the aspects that we've been looking at and how our thinking about government support has evolved for Indonesian SOEs. So on the left, the little pictogram that you see is roughly the 6 big blocks of analysis that we had taken into account when looking at Indonesian SOEs. And we looked at each of those considerations, I would say, in a bit of an equal manner. So no one factor was a key driver in our assessment of the support that the government would provide to its state-owned companies. So we thought ownership was as important as the government influence over the business strategy or the quality of the oversight or the economic importance or the sector importance of the companies. But after a number of SOEs have defaulted in Indonesia, starting in 2018, increasing in 2019, and then really increasing substantially in 2020 and in 2021, we have identified a bit of a thread in the type of companies that the government was going to support. And in Indonesia, we have come up with I would say a more refined analysis on what are the key characteristics that we think will trigger or increase the likelihood of government support. So it's not about oversight. It's not really about the importance of the sector to the economy. It's not about ownership, because some companies were owned 100% by the Indonesian government and they have still defaulted. It is mostly about the commercial sustainability and the profit orientation of the SOE, and the importance that this SOE plays from a public service standpoint. So sectors which are competitive and liberalized, even if they are important to the economy, like the construction or the palm oil sector, they will have, we think, lower likelihood of support than those sectors where it is impossible for an SOE to not do its operations and its activities cannot be commercially substituted by another. So here we have a clear differentiation and a clear thread of government support to these companies. And this kind of analysis, we are doing it across the countries, in China, in Thailand, in Malaysia. And in some countries, it will be the ownership. In some countries, it will be the public service importance. In some other countries, it will be how important an SOE is to the budget, for example. In some others, it will be the oversight and the monitoring. In some other countries, like China, it will be the reputation risk associated with the default of a big SOE. So it's not really a one-size-fits-all. And I think this COVID situation has shown us that government support is no longer blanket, and the governments, they have to take sometimes hard decisions when deciding to support. It's no longer a done deal. So I'm coming to the end of my presentation, and we'll be very happy to get any questions from you on some of the things that I have discussed. But just a few takeaway. The first one is we've seen a stabilization of corporate credit conditions in Asia Pacific since the beginning of the year, but we are not yet out of the wood. Downside risk persists, and we will be seeing more defaults over the next 12 months. That's very, very likely, and I think complacency and some of the green shoots that we have observed is probably a bit too early. Another point that I have emphasized is that idiosyncratic company-specific factors are becoming, I would say, as important, if not more important, than just the sectors in which the companies operate, with numerous companies operating in affected sectors performing very well, and others are facing much more challenging. So sectors are becoming very, very polarized. And the third aspect is really some of the key learnings that us as credit analysts have observed. It's a bit of a going back to basic. Things that we may have forgotten a little bit over the past decade when the market conditions and funding conditions were just so great, is that when a liquidity crisis hit, access to funding becomes very important. Working capital analysis is very important. And governance considerations, which maybe sometimes we tend to forget or put under the carpet because they don't seem to be influencing companies very much. They are coming back to the spotlight when companies need to refinance. So these crises, they provide great opportunities for learning for everyone, for experienced investors, for us credit analysts, and it's always good to reflect upon some of the things we have done and some of the things we could have done better, and be ready for the next crisis, which we will see another one in the next few years anyway. So thank you very much for your time, and we will now move to the Q&A. Thank you, everyone. Okay. So we have a few questions. For the moment, we have received, I think, 5 or 6 questions, and maybe I will just tackle them one by one. I think I overran a little bit on my presentation. So if I can't address the questions live, I'll just reach out to whomever has asked. So we have some questions on the funding conditions. We have some questions on some of the countries that had the corporate sector more affected by COVID. Some questions on governance, oil and gas, the impact on interest rates, SOEs. So let me just start with funding conditions first. So the question is, can you give your sense of funding conditions in Asia Pacific? In which countries or sectors is funding more widely available? What about bank loans and bonds? So it's a very wide question. I could spend maybe 5 minutes or 10 minutes on answering that if we want to go into some details. But I would say the master word for capital providers is selectivity. There is a flight to quality, to the higher quality issuers, as I mentioned in my presentation. Investment grade companies being able to fund themselves very easily across the countries, whether it's an investment grade company in Malaysia or in China or in Indonesia or in India. So really the large companies, the more solid companies, they can fund themselves anywhere at a very low cost. What we are seeing is those companies that are much weaker, what is interesting is it's really hit or miss with the bond market first. So we've had examples of companies rated fairly low in the B flat or even B minus rating level, which does indicate a high risk of default over the next 12 to 24 months, being able to tap the market, because at that particular point in time, there was a group of investors willing to extend credit. And then we have also observed that exactly the same type of companies, maybe even the same business or the same rating level, 2 weeks before, 2 weeks after, couldn't just meet its investor base and had to postpone fundraising. So it's not really that funding is completely unavailable to those weaker companies. It's just that investors are becoming very, very selective in the bond markets, and companies' transaction can go through, or company transaction has to be postponed. What we are observing in terms of sectors is generally working capital intensive sectors are facing more difficulty in raising funds. And those aspects of corporate governance that I was mentioning during my presentation are also coming back to center stage, and companies that are part of complex groups or that have question marks on their governance settings, a lot of related party transactions and so on, they seem to be facing more difficulties accessing the foreign currency bond market. In the bank loans, we are also banking domestic banking systems. We are also observing the same, I would say, selectivity across Asia Pacific as well. I would say countries in Southeast Asia seem to be a little bit more selective than elsewhere. A good example, I think, is in Indonesia. Working capital loan disbursements last year, I think, were down 5%, the first time in more than a decade. And a trend that we are observing as well is for bank loans, even those very, very short-term funding solutions like working capital or short-term credit lines are being more selectively disbursed, I would say, by capital providers. And that's something that's rather unusual, because generally there is much less risk associated with working capital. Domestic bond markets, I would say, have been a lot more resilient across Asia Pacific, whether it's in China, whether it's in Southeast Asia. The markets here, they tend to know their issuers maybe better. They tend to have maybe more confidence in extending credit, more confidence at least than the foreign investors. But yet, for the past 3 to 6 months, we've been seeing actually a growing selectivity in the domestic capital markets as well. So really, funding conditions are very differentiated in Asia Pacific, and the separation is really between, as I said in my presentation, the haves and the have-nots. I will answer one question about maybe a more specific sector. We had a slide showing our expected recovery timeframes for certain sectors. And the question is about the oil and gas. Given the strong recovery in oil and natural gas prices, why would you expect the credit quality of oil and gas companies to only recover beyond 2023? Yes, oil and gas is amongst the sectors that we think are going to recover the latest. There's actually 2 reasons for that. The first one is operations or cash flows are picking up because of higher prices. But that chart is not only about the operation, it's also about the balance sheet side of things. And what we are seeing is this sector is there is continued investment, continued capital spending, in some cases continued dividend payments. And the oil and gas sectors, most of the companies that we rate in there still burn cash. They spend more than what they generate. So even if the profits are going up, the capital spending is still very elevated and the dividend level is high. So they need to bridge that with extra debt or reducing their cash balance, so therefore their credit ratio is not recovering as fast as one would imagine by just looking at the profit statement. The second reason is that our base case price assumption is for declining oil and gas prices in 2022 and in 2023. So we are not assuming that the current high elevated prices are going to persist beyond the next 12 months. I have a question here on SOEs and the risk of selective defaults. Local gets paid and foreigners not. It is an absolute. It's a good observation. It is a risk that SOEs, but not only SOEs, also private companies are actually defaulting selectively on their local currency or foreign currency and not on the other. We've seen a lot of cases. I remember in Indonesia, and there's been a few cases in China as well of companies that continue to service their local debt, especially sometimes their working capital loans. And they actually decide to selectively default on their foreign currency debt. So that's something that will continue to happen. And I think one of the things that we look at is really the incentive of a company to selectively default on one type of debt versus the other. So you will have the cost, of course. You will have the importance of this capital provider. If a foreign creditor is just an ad hoc source of funding, like it has been the case for many issuers in Asia Pacific, especially the small ones, then maybe companies have less incentive to be loyal to this group of investors, whereas the domestic banks, they typically have been with these companies for a very long time. So it's more delicate, I would say, for them to default on those. There is a question here on the potential impact of the US Fed tapering policy and interest rate hikes over the next 2 years on highly indebted companies with speculative grade ratings. Yes, of course, this is a risk that has been ongoing, that we have been looking at for 5 years or 6 years. But I have to say here that every time the interest rates go down, we think it cannot go down much below. And I remember we used to have those presentations where we think, well, it's bound that interest rates are going to rise because of the Fed or because of other reasons, and this is going to create a massive credit problem for the spec grade ratings in Asia Pacific. And I have to say that so far, a lot of the defaults haven't been because companies are paying more for their debt. Because some companies who are willing to refinance, a lot of companies are actually willing to refinance at higher costs. So the big source of potential financial stress is not about the interest rate going up maybe 100 basis points or 200 basis points. It's really about companies being able to refinance to start with, having the capital available to start with. So I would say when you have a lot of leverage, it doesn't really matter whether you're paying a little bit more for your debt. What matters is that you have access to funding to refinance that debt to start with. So I wouldn't say that an increase in US Fed rates is going to have a massive negative impact on the speculative grade rating in Asia Pacific. The impact is going to be a lot more selective. And we will, I think, also have to understand investor sentiment at the time. What's the investor mindset? If investors expect it, then they will be more prepared for it, and they will be able to take that into consideration in their decision. If, on the other hand, it's a very brutal increase, a very rapid increase, what we have observed in the past is this creates a bit of an investor panic. And in Southeast Asia in particular, you start having currency depreciation. And currency depreciation is never a good thing for credit, especially in those currency-sensitive countries like Thailand, Indonesia, Malaysia, and so on, where we could definitely see a lot more defaults because of that second-order effect from rising interest rates. Okay, I think that's all the questions we have for today. Feel free to email me. I think you have my contacts in the presentation. I will hand it over now to Chris Rogers, who is going to speak about the supply chain trends in Asia Pacific. Chris, over to you, and thank you very much, everyone.